Welcome to a new era of personalized investing, where private investors understand that true value lies beyond mere relative performance. Amity recognizes that investing is a deeply personal journey, and success is not just about numbers. Discover a refreshing approach to investing that prioritizes clients' goals and well-being. Unlike ordinary investment options, we are dedicated to a true outcomes-based strategy, bringing certainty to investment outcomes. Don't settle for the ordinary. Embrace the future of predictability and certainty with our outcomes-based investment approach. At Amity, we believe in delivering personalized solutions crafted specifically for advisors' clients, understanding their risk appetite, goals, and preferences. Join us now and unlock the potential of a more rewarding and fulfilling investment experience that goes beyond the mere performance and places the client and their aspirations at the center of everything we do. Reduce uncertainty with outcomes-based investing. Amity Investment Solutions.
Last week we had the privilege of hosting Almien Wagner from Think Capital. If you missed that webinar or the first one that we hosted, we've made them available on our YouTube channel. Now, Almien shared so much insight into the world of hedge funds, and today we have another brilliant speaker, Tumi Loate. Now, Tumi heads up the multi-asset team at 361, and Tumi will give us the long and the short of their hedge fund thinking. I asked Tumi to talk a bit about risk management and also an example of using a hedge fund in a retirement portfolio. As you may recall from our very first intro, where we mentioned the inclusion of hedge funds in the living annuity space. So let's hear what Tumi has to say.
Good afternoon, my name is Tumi Loate, and I'm here to speak to you guys about hedge funds today, and specifically the 361 long short with a long bias equity fund. And this fund was established in April 2006. It's got a moderate to low net exposure. And how we manage this fund is to ensure that we've got shorts against the longs that we manage and put into the portfolio. And this fund also has a low correlation to local and global markets. And it's got an investment strategy that is focused on absolute returns. What does it mean to focus on absolute returns? This means that this fund will protect capital during market downturns as well as during market rallies. So just in terms of the South African listed equities on the fund, the majority of the fund is on the SA listed equities side. But on the international equities, the SARB limits also do apply in terms of the 45% exposure to investments. In terms of the portfolio protection, the portfolio uses put spreads just in terms of ensuring that that net long exposure is protected during market distress events. It also utilizes these vanilla options and option structures to protect the portfolio when the market goes down. Just in terms of the advisors relating to avoiding the 10 worst days, we think it's more crucial, rather than missing the 10 best days, is to miss the 10 worst days in the market. If we were to look at the S&P 500, and this is up until January 2023, you'd realize that missing the 10 worst days in the market actually results in more than double the S&P total returns rather than just missing the 10 best days. So the importance actually in managing that downside protection is extremely important. In avoiding the 10 either worst days or worst months in a portfolio, you can actually have outsized returns versus the index. If we look at the South African JSE listed funds directly, and we were to look at the fund's returns and the worst performing shares over the last 5 years, you'd also notice that quite a majority of these shares have lost more than 90% of their total returns and more than 90% of their returns. And these landmines actually occur in different sectors in the market. So it's not only in the education sector, you're seeing the property sector also coming with immense pressure in the property sector. You've seen the medical companies as well, and healthcare companies also feature there. And quite a number of companies have actually been the worst performing shares for a number of different reasons. It's not just about governance concerns. It can also be about your actual returns and your strategy in your portfolio. 361, how we actually look at covering the stocks in our hedge funds is our investment process is split into two. We've got the long of it, which identifies the businesses that we like and we'd like to hold in the fund. And we've also got the short of it. We like to call this the long and short of it. In terms of the long of it, you're looking at board and management teams that continuously provide a good transparency regarding their quality and capital allocation decisions. You're looking for companies that have a good sustainability in terms of their business model and a good business moat. And the investment decision then is made as a result of them either being able to grow market share or having a brilliant idea that is actually implemented in the market. Whereas when we look at the short of it, the short of it highlights quite a number of these red flags that we look out for when we're investing in a company. And at 361 specifically, there are 4 red flags that tell us when a short actually could come about in the portfolio that could result in a significant decline in your share price. How do we identify these shorts? The first one, of course, is untrustworthy management teams, and this talks to governance. So for us, it's quite important to interrogate management statements, and we need to apply that professional skepticism. It's also important to look at their capital allocation decisions. Have they been able to allocate capital efficiently? And is management, do they have integrity in terms of the statements that they've made? So we always like to keep track of some of the statements they've made sort of in the last 2 years and track them to what's currently happening in the business. The second aspect is a complicated business model. A large number of companies, you aren't able to actually track the moving parts. When you look at the different segments of the business, it becomes very, very hard to keep an audit trail as to which aspects of the business are doing well and which aspects of the business are not doing well. So how then do you justify the actual valuation multiple that this company is on? So complicated business models are usually also a red flag for us in terms of not being able to identify what really is the business strategy going forward. The third aspect in terms of identifying those shorts is earnings with very little cash flow. A lot of analysts typically like to look at the income statement where you get the profitability figures, you get your revenue growth, you get your profitability growth, but not a lot of analysts also like to keep track of what is happening on the cash flow statement. Your cash flow statement ultimately tells you what is the cash that has really come through and that has been earned by the business. And if a company has a very low cash conversion, which means those profitability numbers it's created have not really resulted in increased cash flow for the business, this is also a very big red flag. So for us, companies that are very dependent on revaluations, on accounting once-offs, that do not come through on the cash flow statement, usually are an alarming flag for us to actually see what is happening given this low cash conversion in the business. And then last but not least is your client concentration. If a business is very heavily reliant on a small number of customers, particularly in the government sector, this for us is a concern. If they don't actually manage to get the next tender, what is going to happen to their revenue going forward? We've had a number of companies that have also been on those landmines list that have been very reliant on only a small number of customers. So this basically highlights the long of it and the short of it in terms of our investment philosophy and process. But how does then your hedge fund then differentiate from your unit trust? Because in the unit trust, you also have shares that you don't want to own in the portfolio and you wouldn't include them in the unit trust. But then what does this mean for the hedge fund? The hedge fund strategy is a bi-directional investment strategy. It means I'm not only going to earn returns from a buy and hold, I'm also going to earn returns on the stocks that I don't like. So rather than just be underweight an index in the unit trust, in the hedge fund, you're able to then short these shares to make additional returns from these shorts. This then results in that being able to outperform on an absolute basis because your shorts also offer protection when the market is entirely going down. You're able to then earn returns on these shorts. Besides the shorts, what are the other differentiators of a hedge fund versus the unit trust. The two aspects that I will talk to are derivatives and your leverage. Quite a lot of people get nervous when they hear of leverage and derivatives, but I'm going to highlight some of the myths and misconceptions when it comes to derivatives and using leverage in the portfolio. The first example I'm going to provide is one of short selling a company. And here I'm going to use a hypothetical example, which we actually had included in the part of our hedge funds over the last few years. The first aspect of it, which talks to the short of it in our investment process, is that first one in terms of your management and your governance. Here at Sasol, there were quite a number of issues that were red flags that we had highlighted. The first one being the poor capital allocation decisions when they decided to take quite a large chunk of their money and capital to invest offshore in the United States in a project called Lake Charles. And then you had issues of management not keeping track of this investment and how it was tracking versus the expected performance. The company undertook quite a huge amount of debt to undergo this project overseas. And then you had complicated financials where you actually didn't know, as a result of this debt, was the South African business then expected to pay the interest expense whilst this offshore project was being projected to before it started running. So what we do, just in terms of shorts, just to highlight the short positioning, is when the stock is actually trading at around the 325 mark, this is the opportunity to now look at the short. So we expect the Sasol share price now to decline at the 325 Rand mark. What we do is we borrow the share from a broker, and once we borrow that share, we immediately sell the share in the market. Once we sell that share in the market, we make the 325 Rand, and we get that in cash. Immediately after the Sasol share price declines, and we were quite helped with COVID during those periods because the oil price significantly declined, and then also those issues came about with the Lake Charles chemical project, with them managing that project and it having project overruns and increased budget costs. You saw the Sasol share price reduce to around the 35 Rand mark. So remember, we sold it at the 325 Rand mark. We're now going to buy it back at that 35 Rand mark in which it's declined. We return the share to the people we've borrowed them from, and we have now profited around 290 Rand per share, the difference between the 325 and the 35 Rand in that share. And at this point, when the share price has declined and you're looking at the ZAR and the oil, at this point we think quite a lot now is being priced in terms of the negativity in the Sasol share price. And with the management team having changed, this is now for us an opportunity to buy the share. So when we look at it now from the long of it aspect in terms of the investment process, we now think it's a worthwhile entry point to buy Sasol. And so we take up quite a large portion of these shares in the hedge fund, and we're now profiting from the share price actually going up rather than going down. But this example highlights the fact that you can profit from a share with a large decline and then also have an actual positioning on the long side of the share once the share price starts going up. And this will benefit the portfolio. And the biggest thing and misconception about hedge funds, which we'll always come to speak to, is the fact that they are now complicated, obscure, and too risky. But let me go through some of the myths and misconceptions relating to hedge funds. The first thing is the use of aggressive investment strategies. For us, the use of derivatives in the funds is not actually to increase the amount of exposure and speculative positions. Rather, the use of derivatives is to lower the risk. In effect, by paying for that option, you're paying an insurance that ensures that when the market actually goes down, it protects your portfolio from the market declines. Another important aspect of the hedge funds is that they don't only profit from short-term market movements. The majority of the holdings in a hedge fund position are actually longer-term holdings in their portfolio And I mentioned the long bias of these positions. So you've actually got way more longs than shorts in the portfolio. In terms of accessibility, the hedge funds are not only for large corporates, but we've now have quite a lot of retail hedge funds that have been on a number of general investment platforms, which means retail customers can also now have easy access to hedge funds. Last but not least is the regulatory oversight. Hedge funds are also governed under the Collective Investment Schemes Act, which means they do look at what is your gross and what is your net exposure that you're taking on the fund. And I'll explain now gross and net exposure in a lot more detail. Gross exposure is a combination of your long positions and your short positions. And you're not going to subtract these short positions, you're rather going to increase them to your longs. So let's say you were long 80 and you were short 30. If you were to add up your gross exposure, you'd add up your long positions together with the shorts, and the gross exposures would be 110. However, if you're looking at net exposure, your net exposure to the market is actually the 80 less the 20 on the shorts, so your net exposure would be the 50. The only difference between gross and net exposure is how you're dealing with those short positions. In the one hand, you are adding them, and in the other, you are actually subtracting the short positions. How does this then impact leverage? Your leverage is all your sum of your positions. So if you wanted to look at your leverage of a fund, you can actually then look at your gross exposure because it sums up all your positions in your fund, whether they're longs or whether they're shorts. And if this positioning is above the 100% mark, it means you've got some additional form of leverage in your portfolio. I mentioned the regulatory oversight that takes place in hedge funds. The maximum gross exposure that the retail hedge funds are allowed to take is 200%. So this actually means 100% levered versus your 100% capital that you've invested. Leverage is always a good indication of risk within a fund. Why then are hedge funds considered so risky in a portfolio? If you were to look at a portfolio and look at the longs less the shorts, you're only sitting with 100% net exposure. If you were to say 300 on the long side and 200 on the short side. But if your long positions and your short positions were to negatively impact your funds, both of the positioning, you actually end up being more levered in your portfolio. So let's assume for your 300 long position, you have 10% of your calls you did not make right. So your 300 goes to 270. On your short positions, you also didn't make your calls right on that end. So your 200 that you've lost an additional 10%, which is 20. You end up only sitting with around 270 plus the 180 in your portfolio. Whereas if you look at your net exposure, you've lost almost 50% of your fund, 30 on the longs, 20 on the shorts. So your net exposure now has reduced to 50. If you were to compare then your gross to your net exposure, you go from being 5 times levered to being almost 10 times leverage. So what actually happens and why are these funds considered risky is that leverage. When both sides of your positioning do not work out in your portfolio, you can end up being even more levered than you were to start off with. So it's important then to manage your longs positioning and your short positioning to ensure that you don't expose the fund to too much risks when your long positions and your short positions both can move in the wrong direction. If you look at the majority of the funds that haven't actually done well, particularly in the United States, it's funds that actually had a significant portion of gross exposure. Whereas the funds in South Africa, a large amount of those funds don't even operate at the 200% gross exposure mark. At 361 specifically, we have a very low gross exposure in comparison even to the 200% regulatory mark. If you look at the gross exposure in this fund, the gross exposure has actually averaged around 90 to 140%. Very, very low in comparison to the 200% regulatory mark. If you look at the net equity exposure, it's been around 30 to 70% versus the market at around 100%. What does this mean? It means in terms of risk management, you're actually not as exposed to the market as the unit trusts. A lot of the unit trusts need to be 100% or 95% invested. So these funds are running almost 100% exposure to the market, which means that hedge funds have a very low correlation to the market because of those short positions that come in handy when the entire market sells off. If you look at also the difference between the long positioning and the short positioning, because the shorts can also move in the wrong direction, typically your short positioning in terms of sizing will be a lot smaller than your long positions. In terms of the single amount of short position, we usually don't go above the 5% mark in terms of short positions. How does then your hedge fund prove in terms of these risk management strategies that I've mentioned? If you've looked at the Aussie as sort of the market index over the last 10 worst months over the last 10 years, you will notice that the hedge fund will always, and most on all these 10 months, has actually outperformed the Aussie by protecting a lot of the client's portfolio in the last 10 worst months. If you were to look at March 2020 specifically, when the COVID lockdown occurred, the market fell by almost 12% in that month. Whereas our option structures really kicked into the portfolio, and we actually had almost a 0%, we were quite flat in that month in comparison to the Aussie at negative 12%. But this goes to highlight how you actually outperform during times of volatility. And if the market is expected to have even more volatile periods, hedge funds then will be a lot more helpful in managing that volatility in the market. If you were to now combine all the down months, so we had specifically looked at only the 10 worst months, but if you had to look at the entire, since inception of the fund from 2006 up until June 2023, in down months, how have you performed? When the market has on average been down 3%, we've been able to be in flat. And then on the up months, you try and also capture a significant portion of the up months, which has resulted in an almost 4.3% annual outperformance, combining the up and down months. What does this mean? You've got valuable downside risk mitigating benefits, not only in terms of having a flat return during those down months, but if you had to look at all these risk metrics of volatility, drawdowns, even the last 5 years drawdowns, you'll significantly note that hedge funds will always have a lower volatility, lower drawdowns versus the Aussie. And here we've picked the Johannesburg All Share Index as our market index. In terms of practical application and in terms of portfolio construction, quite a number of clients or advisors ask us, do you guys look at your longs and shorts separately? For us, in terms of portfolio construction, it's extremely important to look at the short positions and the long positions in terms of integrating the optimization of the portfolio. What does that mean? We don't look at the long position separate to the short positions. We look at it as one portfolio. That one portfolio is able to limit some of the risk. Let's say in the banking sector, we're quite neutral on the banking sector, but we quite like the one stock and we dislike another stock. We are then able to do a pair trade. Own the one you like, short the one you don't like, and ultimately have zero banking exposure, but by playing two different companies within the banking sector. Those pair trades benefit the portfolio by increasing the returns, but having significantly lower risk in your portfolio. So how do advisors then use this in their portfolios? If you look at allocating a little bit more to your hedge funds, if you were to allocate 0 versus allocating 60% to hedge funds, you'll note that your performance increases by almost 4% and your volatility drops together with the max drawdown, which talks to some of those downside metrics, risk metrics I mentioned. So adding the hedge fund as part of your various allocations will increase the returns and reduce the risk on the portfolio. In terms of the example of lump sum portfolios in retirement portfolios versus income producing portfolios, we've done 2 examples to show that you invest 1 million in the hedge fund versus the 1 million in the Johannesburg Aussie. For the one fund, no income is required, whereas the second income producing fund, you require 7,500 monthly income, and that increases and escalates at a 6% per annum rate of inflation. What does this mean in terms of your portfolio versus the Aussie? You'll notice that in the lump sum scenario, you have a 79% higher portfolio value since inception. You are not drawing from the fund every single month. Whereas in the income producing scenario, you've got almost 152% higher portfolio value at a lower risk, because when you are actually drawing from that fund, you are not drawing at significantly low parts in your portfolio. Because we've managed that downside in those months, you will not draw from months where you significantly should have had more in terms of your portfolio. So what does this mean for retirement portfolios? It increases your longevity. It improves your return profile, not only for lump sum scenarios, but significantly also for income producing portfolios. I'd now like to summarize. Why should you incorporate hedge funds just in terms of building investment portfolios? The last one I've already mentioned in terms of the longevity risk, making your portfolio last a bit longer if you want to draw from your portfolio. The first 2 speak to the risk management, which is improving the risk return profile and increasing the diversification. So we want to try and actually get returns in both rising and falling markets. And the second part of this risk management exposure is we're always trying to modify that net exposure and use that as a tool, dependent on what we're thinking the market conditions are. This then offers very uncorrelated returns in your portfolio and significantly can benefit an allocation to your hedge fund with the increased returns, given these uncorrelated returns versus the market.
Ladies and gentlemen, thank you for attending our webinar series. What a great lineup of speakers. From Amity, we would firstly like to thank Anchor, Think Capital and 361 who participated. I think Henry, Tumi and Almin were exceptional speakers, and it was such a privilege to meet them all in studio. So when I had the privilege to engage actually with these presenters, they all had the same objective, and that is to educate and inform advisors and end clients alike on hedge funds, on understanding hedge funds and how to include hedge funds. So we really hope that we've succeeded and that we have managed to share some thought-provoking content with you over the last 3 weeks. While we are navigating this different type of economic regime, high interest rates, some instances there are still high inflation going on, and then there's the ongoing talks of de-dollarization and so much more, it seems that many are searching for alternative drivers of returns. I think the key takeaway from what I've seen from the presenters were exactly this. If you do consider a hedge fund, then don't do so because you expect it to increase the returns dramatically. Don't necessarily do it because it is sexy or different. Consider using hedge funds for additional diversification. Consider using a hedge fund when that specific hedge fund within your mandate or portfolio could potentially decrease volatility. Consider using hedge funds as it becomes an additional driver of returns, which is uncorrelated with traditional asset classes. Ladies and gentlemen, we will be back next week, where myself and 2 members of our investment committee team Vian Dahl and Jessica Fannin, will discuss Amity's research and findings on hedge funds. We believe this session will be a great closing statement and hope you will be on the webinar call with us. Thanks again for attending today's session.